While some experts have expressed the view that we may be past peak inflation, Sandeep Bagla, CEO, Trust Mutual Fund, believes this is unlikely given the kind of wage increases we are witnessing within the economy, which he believes could result in sustained services inflation. In an interaction with Business Standard, Bagla also spoke about why a money market mutual fund, which the fund house launched recently, is relevant in the current market context. He also delved into the nuances of the fund management approach that his fund house follows. Do watch this interview for greater details. Welcome to our show, Mr. Bagla.
Thank you so much, Sanjay, for inviting me to your lovely show.
So I have two goals in this interview. First, we'll try to understand on behalf of our viewers the implications of the RBI monetary policy. And then we'll speak about the money market fund that you have recently launched. My first question to you is, another rate hike of 50 basis points has occurred. Some market participants were expecting a 35 basis points hike. Now, what does this rate hike mean for debt mutual fund investors? Where do you see both inflation and the repo rate going from here?
So, any rate hikes typically mean that yields will go up, and it's not a good news for the existing investors. Yesterday, we saw that after the announcement of 50 basis point hike and generally all around hawkish policy, the 10-year government bond yield, which is the most widely tracked instrument for interest rates, it went up by almost 15-20 basis points. However, we also saw that there was hardly any upward movement in the shorter end of the curve, let's say up to 1 year. The shorter end of the curve had already moved up quite a lot in anticipation of the hike. And probably there was no CRR hike, which would have been bad for shorter end rates. So yesterday, the curve slightly steepened. Now, in terms of what the inflation numbers and the future of the repo rate hikes or monetary policy in India, see, we have had high inflation for quite some time. And we ignored it partly because of COVID and the attendant problems of probable growth slowdown. And if you look at US, so now for many years, we had excess supply of money globally, but inflation was not going up. So this seemed an aberration from the theory that the excess money creates inflation. Now it has come back with a vengeance. And in the post-COVID period or in the COVID period, the US Fed took its balance sheet from $4 trillion to $9 trillion. The Japanese Central Bank and the ECB also did their part. They contributed towards the loose monetary policy. That took assets up, commodities up. New classes of assets were created. Cryptocurrencies went up. Stock market went up. NFTs were created. So, that money went chasing returns. And now the US Fed is talking about reducing its balance sheet. So probably that will have some impact on the asset prices. Now, India inflation has been high. Core inflation has been specifically higher than 6% for many weeks now. And RBI has been hiking rate, and we have not even reached the level of expected inflation. So I think, probably it would have been better if RBI had acted more aggressively and slightly more proactively. But it's a very difficult call. There is always mixed data. And one does not want to err on the side of, where the growth takes a hit unnecessarily. But I think this time inflation is very, very sticky and stubborn. besides the normal, food price inflation or oil price inflation, we have the wages inflation. The wages in the markets are going up, and anybody who's trying to recruit people knows that it's very difficult to, uh, hire people at this point of time. And people are expecting 30-40% jump in their salaries. So this kind of wage inflation, I don't think I have seen in the recent years. This is also a global phenomenon. In US also, there are more people, less people than number of jobs. So there are more jobs than the people. And even the yesterday's jobs report was very strong in the US. Now, this kind of wage pressure can lead to services inflation, which cannot come down easily. So I think that RBI will have to hike more, uh, and perhaps keep rates higher for a longer period of time. I think this time the inflation numbers will not come down. So I had quoted yesterday that there is no magic in this monetary policy that you increase 100 basis points and inflation comes down by 200 basis points. It is both science and art. And I think this time this will be quite stubborn and persistent.
What does all this mean for a new investor who is getting into debt mutual funds at this juncture? Which categories should he invest in? How should he go about building his portfolio?
That's a good question. See, about a year and a half back, the rates were really low because the repo rates were very low at about 3 odd percent, and everything else was anchored towards that. And currently, the rates have somewhat normalized. The 10-year yield has gone above 7%. So this is a, I think this is not a bad time for people to invest, especially in, if one were to make a portfolio today, 10% I think should be in liquid for emergency need. Other 40%, 30-40% could be in money market kind of funds, which are giving you 150 basis points higher than liquid, about six half. Then you could try to invest in, short-term funds or banking PSU roll-down funds, which will give you 2-year maturity and 7% yield. And 10-20% you could keep at the longer end of the curve, just in case, Brent comes down and there's a rally in the markets. I think, rates are still likely to go up, and hence I would advise people to stay at the shorter end of the curve, which is also giving you a pretty good interest rates, 6 to 7%, which is much better than what we were getting, let's say, 1 year back.
Would you have any advice for existing investors in debt mutual funds? Some do's and don'ts, any mistakes to avoid at this stage in the rate hike cycle?
So existing investors, of course, I think should try to stay away from the credit funds, because credit funds, while they have returned well, but one really doesn't know what I've seen in the past that the credit funds can be fairly surprising in a wrong way. The other thing I think people should avoid is the lure of the floating rate fund, where people think that floating rate fund will do better when interest rates go up. What people don't realize is that you are locking into a spread to a benchmark when you are buying a long maturity government security, which is floating in nature. And that spread can increase or decrease, and that can lead to capital losses. So I think the existing floating rate funds have exposure to, long government bonds, which do not perform well when interest rates are going up. So I think floating rate funds we don't have a market for floating rate bonds in India. So I would say avoid that. Also, I think the long-term bonds that you are buying, you should not buy more than 10, 20, 30% of the portfolio. So I don't think it's time to be completely adventurous at this point of time. So avoid taking too much risk at this point.
We'll not talk about the money market fund that you launched recently. Could you explain for our viewers what a money market fund is? Where does it invest? And how is it different from, say, a low duration fund, which has a portfolio maturity of about average portfolio maturity of about 6 to 12 months? How is a money market fund different?
So money market fund is a fund which can technically have a maturity from 1 day to 365 days. So it has a more flexibility to the fund manager that in case interest rates look to go up or liquidity becomes tighter, you can come to the shorter end of the curve, which will protect you. A downward cushion will be provided to you. Low duration fund has the mandate at all points of time to be have a duration between 6 to 12 months. Uh, so money market fund is a dynamic fund of the shorter nature or money market instruments.
And how much credit and interest rate risk does this fund carry? If you could give a sense of that for our viewers.
So when we say credit, in India, the, the thinking is that anything below AAA is credit, which is not true. There are very good companies from the Tatas or the Birlas or the PSUs which are AA rated also. And AA also means high amount of safety. So while we'll be investing in short-term papers less than 1 year, which will mostly be rated A1 plus, which is the highest short-term rating, we will also look at the long-term rating of the companies, and up to 20% could be in papers up to AA. Now, we have a tie-up with CRISIL, and based on certain filters, on based on liquidity, stability, and strength of the balance sheet, CRISIL creates a universe for us, and we invest within that universe. So at the first level, we have CRISIL, who's doing the preliminary filtering and giving us a universe. And after that, the fund manager takes its call in terms of where they should invest. So we will be investing maximum into 20% into less than the AAA securities up to AA. 20% would be in sovereign, which is Government of India, and 60% would be in A1 plus rated companies with a long-term rating of AAA.
Would you say that a money market fund is suited for the current environment? Can investors get into it?
I think so, because in liquid fund and overnight fund, you will get return between 5 to 5 quarter. In a money market fund, you could easily get a return of 6 quarter to 6 half. So you are getting about 125, 150 basis points higher. And also, if the fund is a roll down fund where the maturity keeps on coming down. So because the maturity is coming down, if interest rates were to remain moderately flat, there could be an element of capital gain also. So, you are getting almost 100, 150 basis points higher than liquid fund. So in that sense, money market fund is a good fund. You are taking some mild interest rate risk, but if you hold for 3 to 6 months, you will definitely earn something between 5 to 6%. So which is a reasonably good fund.
And what type of investor should get into this fund, and who should avoid this fund?
So, of course, the institutional side is a large, investment surplus with corporates, family offices, banks, HNIs. So they could be one, anybody has surplus money for 3 to 6 months, it's the ideal investment for them. And who should avoid? So people who are looking for returns in double digits or listing gains. So these are the people who should definitely avoid the money market mutual fund because they would not be very too many exciting times here. It's for the steady income earner, fixed income earner, and not for speculations.
Could you explain the limited active approach that your fund house follows? What is this approach?
So, active fund management and passive we have heard. Now, active is gives complete freedom for the fund manager to do whatever they want. You know, limited active is a word which we have coined, and there are various aspects to it. The first is a tie-up to CRISIL. So we have tied up with CRISIL. CRISIL helps us in filtering the universe to come to a certain number of investee companies. So out of, let's say, 250, 300 companies which are AAA, AA rated, we will get a subset of 50 companies. So so that limits the universe in such a way. While we don't like the word limited, but the fact is that it is more to do with having some discipline and structure in the way of investing. Secondly, CRISIL creates one benchmark for us, and that benchmark is based on outstanding bonds of each company. So a company with a higher amount of outstanding bonds gets a higher weightage. Now, based on that, we create a portfolio, in line with that benchmark. So that is also limited active. That we have one more thing, structure that, so it's like a skeleton that you get, and on that you build a body. So you don't get too wrong in terms of what you're doing. So limited active means nothing but that it's a more structured way of doing things. You have a third eye which is helping you in terms of issuer selection, in terms of structuring the portfolio and measuring the performance after the period.
You mentioned that CRISIL offers a bond, a benchmark. What is this concept of tier 2 benchmark, tier 2 bespoke benchmark, and how does it work?
So suppose, if I were to give an example of equity, suppose I am having a rule which says that I will invest in companies which are part of Nifty, but with certain criteria and only in those 10 companies. So then if I compare my fund with the Nifty, it might give a wrong comparison. At certain times I might be outperforming Nifty, certain times I might not be underperforming Nifty. So a better benchmark for me could be following the same style or same strategy. And so SEBI, when we approach SEBI that our universe is little different, our style is little different, and SEBI said that just wait for some time, and after 6 months they allowed us to keep bespoke indexes. So this is just to provide additional information to the investor and the distributor that you should expect this kind of strategy from this fund. So it is in the spirit of more dissemination of information, more disclosure, and more predictably.
Thank you, Mr. Bagla. This was a wonderful interaction. I'm sure our viewers will gain immensely from it. Thank you so much, sir.
Thank you so much, Sanjay.